excited to welcome you to this month's Baird Wealth Strategies webinar. Our topic today will focus on tax planning under the Secure Act. We're joined by Tim Steffen, Director of Tax Planning, and Scott Grenier, Manager of Estate Planning. Today we'll go through the key provisions of the Secure Act, including the most recent IRS announcement, and review ways an account owner and beneficiary can mitigate impact of the new 10-year distribution rule. For those of you not familiar with Tim originally joined Baird in 1999, serving in a variety of planning-oriented roles, most recently as the Director of Advanced Planning. He left Baird in 2019 to join the advisor education team at PIMCO before returning to Baird in 2021. Prior to 1999, Tim worked in Arthur Andersen's Private Client Services Group in Milwaukee, where he specialized in tax and financial planning. His clients included corporate executives, business owners, and families. And for those of you not familiar with Scott joined Baird in 2010, and Scott is currently the manager of our estate planning team for Baird's Private Wealth Management Group. When he's not managing the team, he's helping financial advisors review their clients' estate plans and conducting seminars. So before I turn the call over to them, I do have a few housekeeping items that I'd like to highlight. For optimal viewing, we would suggest setting your layout to that side-by-side view via the circle in the upper right corner of your screen. All participants are in listen-only mode, but we would love to hear from you. So we will host a Q&A session at the end of today's call to address as many questions as time permits. You can submit a question by clicking on that Q&A icon on the bottom right-hand side of your screen. Just please be sure to address your questions to all panelists. This presentation is being recorded and will be made available along with the slide deck through your Baird Financial Advisor or on bairdwealth.com about a week following today's presentation. So again, thank you all for joining us. Scott, the floor is yours.
Thank you, Justine. Tim and I couldn't be more excited to be here with all of you today to present. There's been a lot going on with the Secure Act, which was passed in late December of 2019. Obviously, with COVID and subsequent tax law changes that have occurred since then, there's been little discussion over some of the major impacts of the Secure Act. And recently, as Justine indicated, we have received new guidance from the IRS for proposed final regulations. And we indicate the word proposed because these are not the final regulations, but rather the IRS's view of what these final regulations could otherwise be, absent any changes that are made. And we're going to discuss some of those proposed changes and what they look like and give you our perspective from Baird as to what it is we're doing today and how we're thinking about these proposed changes going forward. I'll start with today's presentation covering two key components here, which is the new rules for IRA owners in light of the Secure Act. Most of these new rules were effective January 1 of 2020. We'll talk about the new rules for IRA beneficiaries, a significant reduction in the ability to take distributions over a beneficiary's entire lifetime. In fact, a majority of beneficiaries are now limited to what they call the 10-year rule. Unfortunately, there are two types of 10-year rules as we're coming to find out, and we'll share both of those with you here. Tim will then jump on to cover the impact of new rules and the planning strategies. I'll come back to discuss using a trust as a potential beneficiary of IRA, the advantages and disadvantages, and then we'll come with some summary and action steps while we also take questions. Our goal is to limit the time that we're speaking to about 45 minutes to ensure that we have enough time to give all of you the opportunity to ask your questions and get those questions answered. So let's get right into it. The new rules for IRA owners. So what changed with the Secure Act that was effective January 1 of 2020? Well, the required minimum distribution age, or the age at which point you have to start taking distributions from your retirement accounts, excluding Roth accounts. That age, prior to the Secure Act or from 2019 and earlier, was April 1st of the year after you turn 70 and a half. Now, we have until April 1st of the year after you turn age 72. Now, for most of our clients, we often see that they'll take a required minimum distribution, an RMD as it's referred to, take a required minimum distribution in 72, and then take their second distribution in the age in which they would turn age 73. Whereas some clients may decide to wait until April 1st or sometime prior to April 1st of the year in which they're going to be 73. So for example, I turned 72 in 2022. I have up until April 1st of next year of 2023 to take my first distribution. Well, as you can see though, if I wait till 2023 to take my first required minimum distribution, I would actually have to take 2 required minimum distributions that particular year. One for my age of 72 that I delayed taking, and the other for my age 73. A key caveat to all of this is, though, that employees of an employer plan may still delay their RMDs, but this is plan specific unless the employee is also a 5% or more owner of the company. At which point in time, if you are a 5% more or more owner of a company, you cannot delay your required minimum distributions. 2 other key points that we'd like to focus on here. One is there was no change to the age at which individuals can take distributions from their retirement accounts without an early penalty. Now, there are other strategies, and working with your Baird advisor, we can highlight those strategies for trying to minimize the impact of a potential penalty on taking an early distribution. But the age is still 59 and a half for taking distributions from a traditional IRA without a penalty. The second key non-change was related to qualified charitable distributions. This age is still 70 and a half. Remember, with a qualified charitable distribution, you as an individual, once you obtain the age of 70 and a half, have the ability to take up to $100,000 and pass that directly to a charity, a public charity. In doing so, that might otherwise offset your required minimum distribution if you are of RMD age, and it does not count towards your adjusted gross income. So, scenario for you, a client age 75 has to take $30,000 for a required minimum distribution in 2022. In that scenario, that client may decide to take up to that $30,000 and give that money through a QCD, this qualified charitable distribution, and give that money directly to a public charity. That $30,000 distribution satisfies that client's required minimum distribution, but it does not go on the client's tax return as a taxable event and does not therefore increase their adjusted gross income, which can help to minimize the impact on other tax features such as Medicare premiums, Social Security taxation, and other potential credits or deductions. That same client could also exceed the $30,000 required minimum distribution amount and go all the way up to $100,000 and provide that same amount to the charity, while also recognizing that while these distributions do not go on your tax return and do not increase your adjusted gross income, they also do not provide you with a tax deduction if you are itemizing your deductions, but can be a very meaningful way of reaching your required minimum distribution setup while also providing for charity in a very tax efficient manner. So, with these new rules, what does it ultimately mean? Well, for us in the planning space, what we're usually looking at is what has this change in the required minimum distribution age from 70 or April 1st of the year after 70 and a half to April 1st of the year after 72. What is this doing for us? Well, the reality is for us, it is giving more planning opportunities by potentially giving us more years where our clients may be not working and may be in a lower income, clients in lower income ranges right now prior to being forced into taking their required minimum distributions. These trough years give us greater opportunities, if you will, to consider Roth conversions, realizing capital gains that allow us to restructure accounts given market conditions, and allows us to potentially take more assets out of the market or shift assets around in more favorable tax years than future years when we know the required minimum distributions could otherwise increase our client's tax situation. So we talked about the new rules as it relates to IRA owners while alive. There's also some new rules for IRA beneficiaries. First, let's get level set and talk about the old rules that we started with. So we have 3 different classifications of beneficiaries under the old rules. We had non-designated beneficiaries. These are typically situations in which there was no named beneficiary or the named beneficiary has predeceased the IRA owner, or the IRA owner has named an estate, their last will and testament, or a trust that does not qualify as a designated beneficiary. More to come on that later. And in those scenarios, in a non-designated beneficiary status, if the IRA owner died before their required beginning date, we'd be set up with a 5-year rule. But if the IRA owner died after their required beginning date, then the RMDs would be based on the life expectancy of the deceased IRA owner. And when we talk about required beginning date, we do note here for you that the required beginning date refers to, again, this April 1st of the year after the IRA owner attains age 72. That is the required beginning date. So we simply look at the beneficiary designation structure, the IRA owner's age at the time of their passing, to determine whether the IRA owner died before or after their required beginning date. And if they died before or after, we then apply these required minimum distribution rules for the various beneficiaries. For spousal beneficiaries, these are the same rules as we had prior, but they're the same for the old rules here, right? In the old rules, it was set up where if we had a spouse as beneficiary, the spouse could collect one of two things. One, the spouse could treat the beneficiary as their own through a rollover, at which point in time, if they did complete their rollover to their own IRA, the surviving spouse would take distributions once they attain age 72, again, using their required beginning date for taking distributions over their own lifetime. The spouse could also decide to treat the IRA as an inherited IRA. And instead of doing the rollover, leave the money in an inherited IRA, and they could defer taking the required minimum distributions until their deceased spouse would have attained age 72. So think about a scenario in which your spouse is younger than you. If my spouse were to pass away at age 60 and I happen to be age 70 at the time, well, if I did a rollover, I would have to start taking my own RMDs at 72. Whereas if I left the money in an inherited IRA, I wouldn't have to start taking distributions from that account until my deceased spouse would have otherwise attained age 72. And it's also notable that with a spousal beneficiary, we can start with an inherited IRA, and at any point in time, we can elect to do a rollover. It's not just a one-time election, but a lifetime election. In addition to the spousal beneficiaries, we then have designated beneficiaries. This was typically anyone other than a spouse and anyone other than the non-designated beneficiary, where the distributions would be based off of the life expectancy of the beneficiary. I pass away, I name my children as the beneficiaries, my children would take the distributions over their life expectancy. And what you'll see at the bottom of each of these boxes is where there have been no changes to the rules and when there has been some changes. For no non-designated beneficiary, the rules are the same. For spouse as beneficiaries, the rules are the same. It's the designated beneficiaries, anyone other than a spouse or a non-designated beneficiary, where these rules have very likely changed into this concept of a new 10-year rule. So what do these new rules look like before we cover the 10-year rule? Again, now we've broken this out slightly more for you from the old rules. We've created two different classifications of these designated beneficiaries. And let's cover that here in a second. First, you'll see the non-designated beneficiary. The exact same rules apply as they did before. For a spouse as beneficiary, the exact same rules apply as they did before. What's different are the two boxes on the right, which are showing us this concept of an eligible designated beneficiary, otherwise known as EDBs, and designated beneficiaries known as DBs. Let's start with the eligible designated beneficiaries. Who are these eligible designated beneficiaries? Well, they are defined as the deceased IRA owner's minor children, not grandchildren, not nieces or nephews. It is the deceased IRA owner's minor children. And these are minor children in the sense that they are under age 21, not based off of the state statute for age of majority. In addition, this also includes disabled, chronically ill individuals, as well as beneficiaries that are less than 10 years younger than the decedent. This could be a significant other. It could be a sibling or any other family friend or anyone else that you have named as the beneficiary. So if I have named my brothers as my beneficiaries and they are less than 10 years younger than me, then my designated beneficiary will be considered an eligible designated beneficiary, and the eligible designated beneficiaries can take distributions over their life expectancy. Very similar to what the old rules and the designated beneficiaries could do. But it's a carve-out for very few individuals, these 4 subsets of types of individuals. Everyone else moves to this classification of a designated beneficiary, including children that are no longer minor children, including any beneficiary that is not disabled and chronically ill and is not less than 10 years younger than the deceased IRA owner. All of those individuals are then considered to be designated beneficiaries, and their distributions are limited to the quote-unquote 10-year rule. So what is this new 10-year rule we speak of? Well, there's been many interpretations, including mixed up in guidance from the IRS that we had as part of the IRS publication 590 and examples that they've provided to us, as well as interpretations from industry experts through and through that all believe that there was the concept of only one type of 10-year rule. Well, the proposed regulations have come out here in March, and in these March proposed regulations have issued 2 types of 10-year rules. So let's give you an example. We have an IRA account owner that dies on or after January 1st of 2020. Their beneficiary is a designated beneficiary. Think about this as maybe being my adult children. Okay? And then I pass away sometime after January 1st of 2020, and my adult children are the beneficiaries. As to which 10-year rule will apply to these beneficiaries, we have to look at how old I was at the time of my passing. Did I die prior to or after my required beginning date? Again, remember, the required beginning date is April 1st of the year after I attain age 72. If I die before my required beginning date, then my adult children would have a 10-year rule that would apply to them in a manner in which they have to deplete the account by the end of the 10th year following my year of death. So if I pass away in 22, that 10-year window starts in 2023. Now, there are no required minimum distributions for these beneficiaries during the 10-year period. They can wait as long as 100% of the account balance is depleted by the end of the 10th year. So there is no required distributions in this green box for these beneficiaries. They can wait until the end of the 10th year. Now, there's likely opportunities from a tax-efficient manner in engaging with their Baird advisor and the client CPA to determine whether distributions could be advantageous to take prior to waiting to the end of the 10th year. But there are no RMDs during the 10-year period as long as the account is depleted. On the other hand, if I were to pass away after my required beginning date, let's use the example of I pass away at age 75, and in that scenario, then my designated beneficiaries still have a 10-year rule, but the new component of this 10-year rule is the fact that these beneficiaries will have to take life expectancy payments on either my age or their age, whichever is greater, which in my example would be my children's age, and that they would take these distributions over their life expectancy in years 1 through 9 and withdraw the entire account balance remaining in the 10th year. Now, this is where the confusion comes in, because we do have situations in which IRA account owners passed away in 2020, where the required minimum distribution rules would otherwise have kicked in 2021, and everyone was under the impression that the green 10-year rule applied to all deaths, whether the IRA owner died before or after. Well, this new interpretation in this orange box of IRA owners that died after their required beginning date would mean that beneficiaries should have received a required minimum distribution in 2021. The IRS has proposed that beneficiaries go back and for 2021 take a 2021 distribution and their 2022 distribution in 2022 while requesting a waiver of any penalties. Now, these are the proposed regs, as we've mentioned before. These are not the final. And rest assured, there are many industry experts and many lobbyists that are going and discussing with the IRS and determining how can we go back and satisfy 21 RMDs when none of our clients even knew that this was a requirement at the time. And do you really want everyone to file a waiver of a penalty for not taking the RMD in 21 when you know, in fact, that they had no ability to really know that they had to take the RMD? So more to come. But if you are a beneficiary, a designated beneficiary, and the account owner died on or after January 1st of 2020, and you know that the IRA owner died after their required beginning date, our guidance is to be aware that there's this potential of 2 different 10-year rules. We are waiting further guidance, and we are not proposing that our clients take any action today. And once the final regulations come out, we will know whether the 2021 RMD must be taken and whether there's a 2022 going forward RMDs that must be satisfied. To the extent that happens, we will have greater guidance for all of our clients and our advisors to ensure that we help you meet the requirements as outlined by the IRS in the final regulations once they are issued. So what does this all look like? Hopefully this chart here, it sums up a lot of what we're seeing out there in today's new rules. We have the non-designated beneficiaries. We have a spouse as beneficiary, eligible designated beneficiaries, and then the designated beneficiaries. And it all comes down to how old was the IRA owner when the IRA owner passed away, and did they die prior to or after their required beginning date? In addition to the changes of these new beneficiary rules, the IRS has also almost simultaneously as the Secure Act, but separately, identified new life expectancy tables to be used. Well, these proposed life expectancy tables were supposed to be effective January 1 of 2021, but with COVID, the IRS delayed the implementation of these new life expectancy tables. However, effective January 1 of 2022, the IRS has updated these life expectancy tables to be used by traditional IRA owners while alive and by IRA beneficiaries when they are alive and receiving an inherited IRA and able to stretch the distributions over their life expectancy. That would be those eligible designated beneficiaries. That would be a surviving spouse. And that would also be individuals that fall under the 10-year rule, the designated beneficiaries that follow under the 10-year rule, where they have to take distributions in years 1 through 9. In those scenarios, the IRS has changed the life expectancy tables. And if you look at the columns here, if you follow age 72, we have the old factor of 25.6, which amounted to a 3.91% distribution ratio. The new factor is turned into 27.4, resulting in a new percentage of 3.65, resulting in a 0.26% difference. Essentially, $260 per every $100,000 is the difference. A reduction in the required minimum distribution of $260 per every $100,000. So a lot of significant changes going on. I'm going to turn it over to my colleague, Tim Steffen, and Tim's going to cover the impact of these new rules and the planning strategies that we are thinking of in working with our clients. Tim?
Thanks, Scott. So yeah, Scott went through and explained what all the new rules are. Now let's talk about what this really means for you as an IRA owner or for your beneficiaries who may be inheriting these accounts in the future. So let's start with the easy one, and that is how does this impact IRA owners today? And the short answer is it doesn't at all. All these new rules we talked about, at least in terms of the 10-year rule, have no impact on existing IRA owners. You'll still be able to, your RMDs will still be the same regardless of this new 10-year rule. There'll be no impact or urgency to take any more out than you otherwise would have had to. So no change on what this means for existing IRA owners. We get into the beneficiaries, however, that's where we're beginning to see some of the significant changes. So let's jump ahead here and show you the impact of this on a beneficiary. We're going to begin with an individual who dies with a $1 million IRA and leaves it to their 55-year-old child. Now, on the table on the right, the first column you see under the blue headed old law RMD, that shows what the beneficiary would have been required to take out of the account on an annual basis based on the old school stretch IRA rules that we're all used to. We're going to assume that this owner was beyond their required beginning date, so they're in RMD mode already. So when this beneficiary inherits the account, they're now going to be subject to this new 10-year rule and all the provisions that go with that. As Scott was explaining, this beneficiary would be required to take annual distributions under these new proposed regulations that are out there, and they could continue to take that same distribution on an annual basis. But when they hit that last year, year 10, they would be required to take everything out of the IRA at once. Over the lifetime or over that 10-year period would be total distributions of about $1.8 million to that beneficiary. Whereas under the old school RMD rules, their RMDs would have only been about $470,000, with another $1.4 million left in the IRA, continuing to grow on a tax-deferred basis. Now, the IRA beneficiary does have the ability to take more out over time, and maybe they would choose to, rather than take small distributions for the first 9 years and then a very large one at the back end, perhaps amortize those, take equal distributions over the life of the IRA. In this example, that would work out to about $124,000 per year, beginning in the year the owner died and every year thereafter, for a total of actually 11 years. That would have meant earlier distributions, so less time for tax-deferred growth, but a more even cash flow stream. And in that case, the beneficiary would have received about $1.4 million over that 11-year period. So you can see there's a big difference in the cash flow impact of the beneficiary, but that's not the only story here. The other half of this story is, what are the tax impacts on these particular distributions? So let's look at how taxes might change the net worth or the net value to the beneficiary. We'll begin with a scenario where you've got a beneficiary who, again, inherits this $1 million IRA at 55 years old. And we'll assume this beneficiary is a top bracket taxpayer. So between federal and state taxes combined, we'll assume a total rate of about 40%. Now, in the chart on the right, the blue bars represent the old school RMD rules. So if this beneficiary had taken just their minimum distribution, the stretch IRA rules prior to all of these changes, taken their distribution out, paid tax and whatever they had to, put the rest into a taxable account, and never touched it, just left money in the IRA to grow, took their minimum amount out every year, again, paid taxes, and then put the rest in the taxable account. And the blue bars represent the total value that beneficiary would have had over different time periods. The red bars indicate or reflect the impact of this new 10-year rule. And we're assuming in this case, the beneficiary takes equal distributions over the full 10-year period, not just RMDs and then a lump sum at the end. We'll assume equal distributions over the 10-year period. Pays the tax on that, puts those dollars in their taxable account, and leaves there to grow again, tax-free, or on a taxable basis, I should say. And what this shows you is that over a 30-year period, this beneficiary would have about $600,000 less after-tax value to their name as a result of these changes. Why is that? Larger distributions, meaning a larger tax cost on each of those, as well as fewer years of tax-deferred growth. Now, this scenario shows a taxpayer who's in the top bracket. Let's change our numbers a little bit and go with a taxpayer who's in maybe a little lower bracket. We'll assume a combined federal and state tax bracket of about 30%, both under the old rules and if they were to take some of these larger distributions over time. In this case, the impact to the beneficiary is even greater. Over a 30-year period, this beneficiary would have lost about $700,000. Let's show one more scenario here, and this may be the more typical scenario where you've got a beneficiary who's maybe in a lower tax bracket under the old rules, but as a result of these larger distributions over a shorter period of time, finds themselves in a higher tax bracket during those distribution periods. And in this case, you can see the impact of the beneficiary is pretty significant. Over a 30-year period, this beneficiary would have lost more than $1.1 million of value because of the accelerated tax cost and the fewer years of tax-deferred growth. So we said before that the owner of the IRA is not going to be impacted by this new 10-year rule. This doesn't change how they take distributions out over their time. This is really an issue for the beneficiaries. But what's odd about this is that all the steps that can be done, or most of the steps that can be done to mitigate this, really fall on the owner. Once the beneficiary inherits the account, there isn't really much they can do about this. So now it becomes an issue for IRA owners. How much effort and how much do you want to put into mitigating this tax impact for your beneficiaries? Your beneficiaries are going to lose significantly as a result of these new rules. Now, you as an IRA owner may say, you know, my kids are still going to inherit a very large account. it's going to be more than I ever inherited, and tax laws change. There's not much I can do about that. I'm sorry this has happened to them, but I'm not going to change my whole way of thinking of my retirement account just to save them some taxes during their lifetime. And that's a perfectly viable approach to things. But there are going to be those owners who will want to do something to help mitigate this, help support their beneficiaries, and make up for some of this lost growth that they're going to have because of these accelerated taxes. We are going to spend the next several slides going through 6 different ideas, 6 different ways you as an IRA owner can help mitigate the impact of these new rules on your beneficiaries. We do have one other idea that can be implemented by the beneficiaries themselves, and we'll wrap up by talking about that slide. But let's begin by talking about things that an IRA owner can do today. And we'll begin by talking about tax-efficient beneficiary designations. Now, if you're the owner of a retirement account or other financial assets, and you have multiple children or other beneficiaries you want to leave your assets to, it's very typical to leave those assets on a pro rata basis. If you've got 3 kids, each of them gets 1/3 of each of the accounts that you have. 1/3 of your retirement accounts, 1/3 of your Roth accounts, 1/3 of your life insurance, 1/3 of everything else that you've got. But it's important to understand that just like you can choose which physical assets to leave to your kids, who gets the grandfather clock and who gets the wine collection and who gets the collector car, you can do the exact same thing with your financial assets. You don't have to leave all your accounts equally to each of your kids. You can be more tax efficient in how you designate beneficiaries to these. By doing so, we can leave more money on an after-tax basis to those beneficiaries, while they may end up with larger net inheritances. This can be a little tricky to implement because it does require you to update beneficiary designations on a periodic basis as tax laws change or account values change or beneficiaries' tax rates change. But done strategically, you can increase the net inheritance to all your beneficiaries. Let me show you an example of this. Let's take a scenario where we've got an IRA owner who has 2 children. One is in a higher tax bracket, 35%. The other is in a lower bracket, 22%. This particular individual has an estate, as you can see on the right-hand side, that comprises of $1 million taxable account, a $2 million traditional IRA, and $1.25 million of other tax-exempt assets. These could be Roth IRAs or life insurance policies. Now, into the traditional scenario where you might divide each of those accounts 50-50 among the 2 kids, you get the scenario you see on the left, where the 2 children each receive an equal amount on a pre-tax basis, but the child who's in the higher tax bracket ends up $130,000 behind their sibling who's in the lower bracket, simply because they receive more tax-inefficient assets. Instead, rather than automatically splitting all your accounts 50-50, you can be more strategic in how you leave assets. For example, leave your tax-exempt assets to the child in the higher tax bracket. Leave your traditional IRA assets, the taxable ones that are fully taxable, to the child in the lower bracket. And then equal things out by splitting the taxable account more strategically. In this case, on a 59-41 basis, for example. What you can see here in the chart on the right is that not only do both beneficiaries end up getting a little bit more net inheritance, you also reduce the overall tax cost and save each of them a little bit of money. So be more strategic on your beneficiary designations. Don't always default to pro rata across all of your individual beneficiaries. Our next idea is about it has to do with how the IRA owner is going to spend assets during their lifetime. We know most individuals prefer to avoid taxes whenever they can. As a retiree, you may be more likely to take money for spending out of things like Roth accounts or taxable accounts where the tax cost may be less, and only taking what you have to out of your traditional IRA. Unfortunately, that sometimes leaves some extra tax planning on the table, as often retirees find themselves in a lower tax bracket than their heirs might be. You figure your kids are going to be inheriting assets when they're at their peak earning years, the highest tax brackets they're going to be at, whereas retirees tend to be in much lower brackets during the retirement period. A better approach might be to have the owners of the retirement accounts, mom and dad in this case, to spend down their assets in the IRA, use those assets to fund their spending during retirement, while leaving accounts like Roths or taxable accounts as direct, and leave those directly to the kids. Not only will you take advantage of being in a lower tax bracket than your children by spending down the IRA, you will leave them assets that are either in a Roth account tax-free or might get a basis step up upon death, eliminating any capital gain. Now, this is a great strategy for those who are looking to find ways to spend down their assets during retirement. What about those IRA owners or retirees who say, I've got my spending covered. I don't need to take anything more out of my IRA than what I'm already taking. I've got plenty of other sources of income. I don't really need to spend anything. But I would like to take advantage of the fact that I'm in a lower tax bracket. Well, that's where our next strategy comes in. And it kind of takes this idea of spending down the IRA during a lifetime up to the next level. We're talking about using a Roth conversion. Now, Roth conversions have been one of the most talked about strategies to take advantage of or to mitigate the impact of this new 10-year rule. It can be a great way to take advantage of the IRA owner being a lower tax bracket than what their beneficiaries might be when they inherit the assets. Now, this strategy has a lot of the same advantages and disadvantages we talked about on the prior slide. It takes advantage of the IRA owner being in a lower tax bracket than their beneficiary. It allows for more tax-free and and growth in the taxable accounts and the Roth accounts. The trick here is you have to be very careful about how you handle a Roth conversion. If the owner gets too aggressive with the conversion, they can end up paying more tax than what the beneficiary might pay. There's an opportunity cost because you do have to pay those tax dollars up front. So there's some lost earnings on those dollars that are spent up front. And remember, the Roth is still going to be subject to the 10-year rule. It doesn't get around the distribution requirements over that 10-year period by simply converting it. But you do get to take advantage of more years of tax-free growth. Let's take a look at a few examples on how this might work. Begin with a scenario where we've got an IRA benefit or IRA owner who is 65 years old today, and we'll assume an age 90 life expectancy. So they're going to live for another 25 years. They have an IRA worth $500,000 that they are considering converting. Now, at this point, both the owner and the beneficiary will assume are top bracket taxpayers. They're both in that 37% bracket. And we'll assume that the beneficiary and the owner don't plan to spend any of this money. They're simply going to take out what they have to, pay the taxes on it, and put what's left in another savings account where we continue to grow on a taxable basis. Now, looking at the chart on the right, the blue bars represent the do nothing scenario. The owner just leaves the $500,000 in their traditional IRA, takes the required minimum distributions out on an annual basis, pays the tax on it, and saves what's left. Leaves it to their beneficiary upon their death in 25 years. The beneficiary takes pro rata distributions over the 10-year period. So they take large enough amounts out that at the end of the 10 years, they fully liquidated the IRA, pay the taxes on those, and put them in a taxable account as well and don't spend it. That's the blue bars. And you can see how the account value will grow over time. The orange bars represent the Roth conversion scenario, where the owner converts the Roth IRA to, or converts the traditional IRA to a Roth today. Pays tax on the $500,000, but then moves it to a Roth and never has to touch it again during the rest of their lifetime. At their death, it passes to the beneficiary, who also doesn't have to take any distributions during the first 10 years, but then would liquidate it all at that 35-year mark. But continue to put the money into a taxable account and not spend it. And what you can see here is that over a period of time, eventually the Roth conversion scenario provides more after-tax value to the beneficiary than the non-conversion scenario. It does take time. The break-even point here is at about the 18 or 19-year mark, maybe 17 years, something like that, depending on the scenario. But as you can see, over time, the Roth quickly becomes more and more valuable on an after-tax basis than the traditional IRA to that beneficiary. To the point where over about a 40-year period, the difference in value between these two scenarios is about $1.8 million. Let's change our assumptions here a little bit. Let's change our tax rates. Let's assume we've got an owner who's in a lower tax bracket today, only a 24% bracket. Although if they do the conversion, they jump up to a 32% bracket. The beneficiary, again, a lower tax bracket taxpayer as well. In this case, again, you see a similar trajectory in the after-tax values. It takes a little while. It takes about that same 20 years or so before we hit that break-even point. But at that point forward, the Roth continues to provide a larger benefit over the traditional IRA. Not as great as in the scenario we just saw. The total value is much larger, but the difference between the two after 40 years in this case is about 1.2 million. But again, clear advantage to the beneficiary by having converted. We'll take a look at one more scenario here. This is the one where an owner, again, is in a much lower tax bracket than their beneficiary. They pay a lower tax on their distributions today and a lower tax on the conversion, whereas the beneficiary is in a much higher tax bracket. So in this case, the blue bars we're looking at are the same as what we saw on the prior slide. But because of the beneficiaries being in a higher tax bracket, they really benefit from the Roth IRA. In this case, the difference over a 40-year period to the beneficiary is about $1.5 million. Now, as you can see here, given enough time, the Roth scenario, the conversion to a Roth today by the owner, and then leaving it in there for as much tax-free growth as possible, is going to provide a better answer for the beneficiary. The trick to this is it does take time. The owner may question, why am I paying all this tax in this conversion today when I could have just left it in there and paid taxes in smaller amounts over a longer period of time? It does take a period of time for this to come to a break even. In most cases, right around 20 or so years before the Roth does tend to catch up to the traditional on an after-tax basis. What if we change some of our assumptions? What if we looked at maybe perhaps an older IRA owner? Let's say you're an IRA owner who's age 80 today and has that same life expectancy of 90. Well, they're not going to have as many years of tax deferred growth with a shorter life expectancy. But even with that, the Roth is still going to provide a better answer to the beneficiary over the long haul, simply because the taxes are going to be deferred that much, or they're going to be able to get more years of tax-free growth, I should say. The benefit won't be as great for an older owner as it might be for a younger IRA owner. So an age 80 IRA owner won't see quite the benefit that an age 65 owner might see. And that 80-year-old owner might not even see any benefit during their lifetime, given that they're older at the time of the conversion. But ultimately, given enough years, the Roth conversion scenario will work out better for the beneficiary. We also assume that nobody touches this account during the lifetime. You just take out what they have to and pay taxes on what they have to, but don't actually spend any. If you have a beneficiary who's going to be using the Roth to live on, to be taking distributions from it, again, the more they take out of the account during their lifetime, the bigger advantage the Roth is going to be, especially when parents are at a lower tax bracket than the beneficiary, which makes sense. Have mom and dad pay the taxes while they're at a lower tax bracket. When the beneficiary is older and is taking money out of the account during retirement or after mom and dad pass, those distributions will come out tax-free. All right, let's move on to our next scenario, or our next planning idea. And that has to do with using the IRA for charitable purposes. Let's say you've got an IRA owner who is charitably inclined and wants to make gifts to the charitable organizations they support. They could use outside assets, taxable assets, appreciated positions they might have, whatever it might be, to make those distributions to charities while continuing to leave their dollars in the IRA. However, the qualified charitable distribution rules, which Scott talked about earlier, may be an opportunity for the IRA owner to use up some of those IRA dollars today on a tax-free basis if they go directly to charity, while leaving those taxable assets to the beneficiaries. And because of the step up in basis rules, those assets, any gain on those appreciated assets would go away at the owner's death, meaning you're effectively leaving tax-free dollars to the beneficiary. Scott talked about the rules on qualified charitable distributions before. All of those still apply. Just to reiterate the one that he mentioned earlier, even though the RMD rules have now changed to begin to push RMDs out to age 72, qualified charitable distributions can still be made at age 70 and a half. So this is the great technique for those who are charitably inclined. But what about those who are really charitably, really want to take advantage of some of the charitable transactions or techniques that are out there? Well, that takes us to our next scenario, our next planning idea. That is to leave your traditional IRA to a charitable remainder trust. A charitable remainder trust, just to give you an idea how this would work. If you name a charitable remainder trust as the beneficiary of your traditional IRA, what happens is at your death, the IRA essentially gets liquidated. It ceases to be an IRA. But all the dollars go into this charitable trust. And because it's a charitable trust, there is no tax cost on that distribution. So now you have a charitable trust that owns all the dollars. And because it's a remainder trust, the way it works is distributions that are made to an income beneficiary, your kids or any other individual you want it to be. They take distributions out based on the terms of the trust. All the remaining dollars stay inside the trust, again, on a tax-deferred basis. And at the end of the term, or at the end of the death, or the death of the beneficiary, whatever's left in the trust goes to the charity. That's the remainder. Now, the idea of leaving it to a charitable remainder trust is then, again, one of the most talked about strategies for mitigating the impact of this 10-year rule. It preserves all the tax deferral of the IRA because it is a charitable account. There's no taxes on the earnings in there. The only tax that is due is paid when the distributions are made to the beneficiary over that lifetime after the owner's death. The trustee, because it's in a trust, maintains complete control over the principal. This is really much like the traditional stretch IRA, replicates a consistent income stream to the beneficiary while maintaining tax deferral. There is, however, two big drawbacks to this. One is setting up a charitable remainder trust can be complicated. You have to get an attorney involved to draft the trust. You need a trustee involved to manage the assets. You're going to need an accountant or a CPA involved to prepare the tax returns for the trust and probably for the beneficiary as well, if they'll be getting a K-1. But the bigger issue on leaving your assets to a charitable remainder trust is that it removes all the flexibility from the beneficiary. Remember, they're getting that fixed income stream on an annual basis, but that's all they're getting. They don't have access to the rest of the principal of the trust. All they receive is that distribution that's determined at the time the trust is funded. And upon their death, all that's left in the trust, or at the end of the trust term either, will go directly to the charitable entity. The beneficiary doesn't get to choose where the principal in the trust goes after their death. So let's look at a couple scenarios on how a charitable remainder trust might work. Again, we'll take our beneficiary who is age 55 and they inherit there's an IRA balance of $500,000. We'll look at two different scenarios. The first one would be leaving the money directly to the beneficiary, and that'll be the blue bars you see in the chart on the right. In this case, the beneficiary gets their $500,000 IRA, takes their distributions out pro rata over that 10-year period, because they are subject to the 10-year rule. Pay tax on their distribution, put the rest into a taxable account, and let it grow there on a taxable basis for the rest of their life. And you can see by the blue bars representing their after-tax value over 10, 20, and 30 years. Now let's compare that to the CRT scenario. You leave the IRA to a charitable remainder trust. And in this case, the trust allows for a 5% payout. What happens is every year the beneficiary gets a payout of 5% of the assets of the charitable remainder trust. Those dollars come out fully taxable to the beneficiary. They pay tax on them and put them in their taxable account. And you can see that over a 10, 20, and 30-year period, after a 30-year period, the IRA beneficiary in this case has received about $250,000 less value. That's because of the smaller distributions and the inability to access the principal in the trust. Now, to be fair, in that 30-year period, there's another $900,000 sitting in that charitable remainder trust that's going to go to a charitable beneficiary. So overall, there's much more value available here. But think about what we're trying to accomplish. We're trying to mitigate the loss of that value to the beneficiary because of the accelerated taxes and the lack of tax-deferred growth under this 10-year rule. While this may be a great strategy for funding a charitable obligation, it is not taking advantage or not fixing the problem that the beneficiary has, which is the lost value they'd be getting under these new rules. Now, we can't change the scenario up a little bit. This shows a 5% payout. So 5% of the assets go to the beneficiary each year. Let's increase that to 10%. In this case, the beneficiary gets a 10% distribution of the value of the trust every year. And again, pays tax on it, puts the after-tax amount in a regular investment account, and lets it grow from there forward. And what you can see here is that after a 30-year period, the two scenarios have come to about a break even. So now at this point, the IRA beneficiary does have about the same after-tax value as they would have had in the original scenario. However, the value of the amount going to the charitable remainder trust is significantly lower. In this scenario, only $200,000 left to give to the charitable beneficiary. All right, let's move on to our last strategy for the IRA owner themselves. And while it might be the easiest to understand, it may not always be the easiest to implement. Remember, the idea is we're trying to provide or replace some of that lost value, the amount that's gone away to taxes or lack of tax-deferred growth to the beneficiary. Maybe the easiest way to do that is to have the IRA owner purchase life insurance. They buy a life insurance policy that pays off upon the death of the owner. It effectively replaces that lost value to the beneficiary. And if you use it in combination with an irrevocable life insurance trust, the IRA owner, to their death, can maintain control over those assets, limit the beneficiary's ability to access it, provide more control over it, protect it from creditors and others who may be trying to access that money. So it does provide some added control for the beneficiary, or for the owner, I should say, for the deceased owner. The downside to the life insurance strategy, the IRA owner may not be insurable. If you're thinking about if you're a younger individual, you may be able to purchase that life insurance at a reasonable cost. But as you get older, the cost of that insurance becomes almost prohibitive. You may not even be insurable anymore. There are also other administrative costs to consider. You need an attorney to create the life insurance trust. You'll need a trustee to administer that. You may need a CPA again to prepare the tax return for the trust. There may be some gift tax considerations as well when you pay the premiums into that insurance policy. So while life insurance might be the easiest one to understand, it may not be the easiest to implement. So those are the 6 strategies we've come up for IRA owners today to help mitigate the impact of this 10-year rule. I said we had one other strategy we're going to cover, and this is something that can be done by beneficiaries. Everything we've talked about can only be done by the owner. Once the beneficiary inherits the IRA, they can't do a Roth conversion. They can't do the charitable remainder trust. They can't purchase more life insurance. But what they can do is make tax strategic IRA withdrawals. Now, this strategy isn't maybe as great as we once thought it was because of these new regulations that do require beneficiaries to take required distributions over the 10-year period. But it does still give the beneficiary some flexibility to manage the payments out of that account. Beneficiaries should be more careful about when they take money out, take smaller distributions in years where they're on higher tax rates, take larger distributions in years where maybe they're on a lower tax rate. For example, maybe the beneficiary inherits the account when they're later in life, later in their working years. And for the first few years after they inherit the account, they take smaller distributions out, just a minimum amount. But then at their retirement, they find themselves in a lower marginal tax bracket, they can then resume larger distributions beyond what even they're required to take out, to take advantage of the fact that they're in a lower tax bracket for those later years of life. So those are the strategies we've come up with to help mitigate the impact of this. I'm now going to turn the call back over to Scott to wrap up with a couple of other strategies regarding using a trust as the beneficiary of your IRA.
Thanks, Tim. Looking at time here, knowing that we're running up against time and wanting to ensure we offer everyone the ability to ask questions, I'm going to pass through the trust as beneficiary this section relatively fast here. So let's go through this. First, using a trust as the beneficiary of an IRA is done very frequently, and we're seeing more and more of it be done with the change in the required minimum distribution rules and the ability for beneficiaries to stretch out the distributions. What we're finding is that if the trust is named as a beneficiary and quote unquote qualifies as a designated beneficiary, then we can achieve the same stretch out capability, such as the 10-year rule or life expectancy for an eligible designated beneficiary, as if we had named that person individually, but we get the terms of the trust to actually serve as the beneficiary. So the advantage is asset protection, maybe using up federal estate, state estate, or even generation skipping transfer exemptions upon the IRA owner's passing, or trying to ensure professional asset management of the assets. But the disadvantages is the administrative complexity of the drafting style needed by the attorney to complete this, and the ongoing cost structure when a trust is the beneficiary and you have an irrevocable trust. And the trust is going to have to file a tax return each year. Whether the trust retains the income or distributes the income, it'll still file a tax return, making it, again, a little bit more administratively complex and a little bit more costly on an annual basis. So how do we get a trust to qualify as a quote-unquote see-through trust and as a eligible designated beneficiary, a designated beneficiary? Well, there are 4 requirements. The first is that the trust is valid under state law. Second is the trust becomes irrevocable at the IRA owner's passing. Third, a complete copy of the trust is provided to the plan administrator, in this case Baird. And fourth, which seems pretty innocuous but actually comes out to be the most significant and the most challenging, is that the beneficiaries must be identifiable. Well, what does this identifiable mean? Well, when we think about what we call a conduit trust, it just means that all IRA distributions must be passed out to the beneficiary in the year in which they are passed from the IRA to the trust. All IRA distributions must be paid out to the beneficiary from the trust when they are paid out from the IRA to the trust, and from the trust then to the beneficiaries. In that scenario, the identifiable beneficiaries is, in fact, the person receiving the distributions from the account. So the advantage is its simplicity in drafting, and that the income tax flows from the trust to the beneficiary of the trust. The disadvantage? Well, if that beneficiary lives to his or her life expectancy and they're an eligible designated beneficiary, well, there's likely to be very little remaining in that account. Think about a scenario with in a second marriage and the surviving spouse living to their life expectancy and receiving distributions each year over their lifetime. There'll be very little remaining in that account for the children of the IRA owner. And with designated beneficiaries, where we have these 2 different potential 10-year rules, well, this trust and the IRA distributions will have to be depleted within the 10 years, and the beneficiary will receive those distributions in that 10-year time frame. If we do not use conduit language, we call this an accumulation trust or discretionary trust. It's any see-through trust that would qualify as a designated beneficiary that is not a conduit trust. There's ways in which we can get these trusts from a drafting perspective to still qualify as a beneficiary. The advantage is the trustee has the discretion over the timing of distributions and the amount of distributions. While it may not be as tax efficient to retain the money in the trust and for the trust to pay the taxes, there may be valid reasons for the beneficiary to not receive the distributions. But there is the complexity in the drafting, and again, if the income is not distributed, then the trust will pay the taxes at the trust tax rates, which oftentimes is at a higher rate than what those of an individual would pay. So we can cover trust as beneficiary as an IRA with your Baird advisor in greater detail, but let's talk about the action steps. One, we would always say, always review your retirement account beneficiary designations. I would also go further and say any account titling, including real estate, bank accounts, brokerage accounts, etc. But specifically with IRAs, look at your beneficiary designation, ensure that they are the individuals or entities that you want to have on there. As Tim talked about, evaluate the impact of the potential 10-year rule for these designated beneficiaries. And engage with your Baird advisor to discuss tax and estate planning opportunities to address strategies for these rules, considering Roth conversions, charitable remainder trust, spend down strategies, strategic withdrawals, and using a trust as a beneficiary. With that, Tim and I are now going to take questions. There are a bunch of questions that have come through the Q&A online here. And so as Tim and I get some questions here, Tim, if you have anything to start with, go ahead. Otherwise, I'm going to filter through some of these and then I'll pick up some of these questions as well.
Tim, before you start too, I'll just mention it is at the 4 o'clock mark. So if you do have to hop, we completely understand. But for those of you that want to go through Q&A, we'll take some time and answer that now.
We had a question come in about tax law changes and and what might be changing for 2022 or beyond. At this point, there are no other tax law changes that have been implemented. I know a lot was talked about last fall, but all the same tax brackets that have been in place for the last couple of years are still in place for 2022. And quite honestly, we don't expect any dramatic changes to anything for this year. That could change for next year, but for 2022, nothing has changed at this point. So all the same rules that have been in place for a while continue to be in place. Let's see here. Scott, have you got a couple you want to jump in on?
Yep. So a couple of questions here, confirming that when we go ahead and give the RMD to charity through a qualified charitable distribution, that does not qualify as a deduction on the 1040. That is correct. If you are giving the money through a qualified charitable distribution, it is not reported on your 1040 towards your adjusted gross income, and then therefore it is also not deductible on your 1040 either. Another question came in regarding a client who has a daughter that has passed away, and her daughter's 401k was with an employer, and her oldest son and beneficiary were the named beneficiaries, and the firm is indicating the assets must go to a spouse. There are requirements through qualified retirement plans, non-IRAs through ERISA, qualified retirement plans that do require a spouse to be the primary beneficiary. And unless the spouse signs a spousal consent form, they will require the assets to be paid to a surviving spouse and not the child. Now, the question here is related to a sibling who is older than the IRA owner. Would they otherwise qualify as an eligible designated beneficiary? In that scenario, they would, because they are not less than 10 years younger than the original IRA owner. They can be more than 10 years older, they just can't be more than 10 years younger.
There's a question about how does this new 10-year rule affect traditional IRAs or Roth IRAs? With a Roth IRA, the 10-year rule still applies. So you still have to take the distribution out by the end of the 10th year, but that new regulation that Scott talked about having to take annual distributions, that does not apply. So if you inherit a Roth IRA, you still get to leave the money in there for the full 10 years before you have to take anything out. So you can maximize the tax deferral or tax benefit on that account.
Great point, Tim. So with Roth IRAs, they do not have a required beginning date, and therefore they do not have these options for these two different 10-year rules, but rather the one 10-year rule where they can wait to the end of the 10th year. Great point. Another question came up on qualified charitable distributions. Can they only be used to offset required minimum distributions, or can they be used for other withdrawals from an IRA for someone that is, let's say, between 70.5 and 72? And the answer here is yes, a QCD can be used to satisfy RMDs when you're in RMD age, but they can also be used in addition or subsequent to RMDs, and they can start as early as 70.5, even if you are not in the required minimum distribution phase. Just again, remember that the total QCD amount is a total of $100,000. And then the last question I have here is, did the RMD age change to 73 on January 1 of 2022? No, the RMD age is still 72 at this point in time, or April 1st of the year after attainment of age 72, to be more specific. And that age holds true for now. We will wait to see what other further legislation we might receive in the future, which could otherwise increase those ages.
take a couple here, Scott. There was a question about who determines the CRUT payout for a charitable trust. That's determined by the person who creates the trust. So we gave the examples of the 5% payout or the 10% payout. It's really up to the person who funds it. How much do they want to distribute out to the beneficiary? Keeping in mind, the more you give to the beneficiary, the less that goes to charity over time. So you got to try and find that right balance. There was another question in here about another tax law change question, so I can find that here. Oh, shoot, no, I don't see it. Sorry, Scott, if you get another, let's see, with traditional IRA inherited in 2021 and death of an owner, do beneficiaries have to comply with minimum distribution in 2021 per the regs? The issue is there, if the IRA owner was already in RMD mode when they died, there's still a distribution that comes out to the IRA owner in the year of death, or for the IRA owner in the year of death. The beneficiary doesn't actually have to start taking money out of the IRA until the year after the owner's death. So if the owner died before their required beginning date, there'd be no distribution required in the year of death. You wouldn't have to actually start until afterwards. So no, there's no distribution in the year of death for the beneficiary that's required. They certainly can if they want to take money out and start managing some of the tax costs, but they don't have to. There's another question I was going to get to, the one about how secure are we on the Roth provisions. As secure as we are with any tax law. I always say there's no such thing as a permanent tax law. Having said that, Roth IRAs, if we were worried about a Roth IRA being treated as a taxable account at some point, I think that's a pretty minimal risk. Maybe you see more required minimum distributions on Roth IRAs, but getting rid of Roths in the future seems pretty unlikely. Justine, you want to say a couple more?
Completely up to you guys. If you have time to stay on, we'd love to hear a few.
Go ahead, Scott, if you got any. It's a qualified charitable one that just came in. It says, is it $100,000 to charity for each owner or for the family? It is $100,000 per IRA owner. So you got a married couple, husband and wife, they could each use $100,000 of their own IRA, but you can't use $200,000 out of one spouse. They do have to come out of each individual's IRA if you wanted to maximize the QCD.
So I have a couple others here just surrounding trust as beneficiary. Can I name my revocable trust as my beneficiary of my IRA or 401k? The simple answer is yes, you can. Most revocable trusts become irrevocable upon the IRA owner's passing, and therefore would still meet part of the IRS 4-part test, which is for the IRA or for the trust to become irrevocable at the IRA owner's death. So yes, you can name a revocable trust that becomes irrevocable at your passing. Another one was related to using a trust for grandchildren. While the grandchildren would not qualify as a minor child for the eligible designated beneficiary rule and the stretch out until age 21, and then life expectancy till 21, and then a 10-year rule from 21 to 31, the grandchildren could otherwise qualify as a designated beneficiary, either if they're directly named or as an eligible designated beneficiary, at which time, again, we would be looking at, do these beneficiaries have to take the 10-year rule based off of, just depleting at the end of 10 years, or do they have to take life expectancies in years 1 through 9? Another question, if all on the named beneficiaries have predeceased the IRA owner, where will the IRA go? This is very custodian specific here at Baird. If an IRA owner should pass away and there are no named living beneficiaries, then the IRA owner's estate becomes the beneficiary. And since the estate is the beneficiary, that is when we go to either the 5-year rule or what we call the ghost life expectancy rule, which is using the deceased IRA owner's remaining life expectancy for the estate at that time.
We do still have questions coming in here, but if you guys want to maybe pick one more and then we'll wrap it up.
There were 2 Roth ones that come in. I think I can combine them into one answer here, and then we can wrap it up. So talking about Roth conversions phasing out in the future, and does that make Roth contributions to 401ks better? In terms of conversions, there's nothing changing on Roth conversion rules at this point. It's been talked about, but nothing has become final at this point. So no worries there. And then on contributions, are you better off contributing to your traditional 401k or your Roth 401k? Your beneficiaries would tell you they'd rather have you contribute to the Roth 401k because they inherit it tax-free. But that may not be the best answer for you. So you have to look at your specific in your particular situation. You may find that the traditional 401k is actually the better answer. Take advantage of the deductions while you're working, and then get taxable income during your lifetime when you're in a lower bracket. But that's a very case-specific scenario that we could talk about with your financial advisor.
Great. Thank you so much, Tim and Scott, and thank you everyone for your time today. For those of you, if you would like to review today's presentation or listen to the recording, both of these can be obtained through your Baird Financial Advisor, or it can be obtained on bairdwealth.com under the Insights and Education tab. Just give us a few days for it to get posted there, but like I said, it will be available for all of you. If we weren't able to address your question, I know we still have some coming in. Feel free to reach out to your Baird Financial Advisor. They will loop in the appropriate resources for you guys to get in contact with. So thank you all again and have a great rest of your day.